SLB's margins are increasing, but does this indicate a buy opportunity despite debt levels approaching $10 billion? In our analysis, we'll reveal the strengths and potential pitfalls in SLB's financials, evaluating whether its operational gains outweigh the risks. Stay tuned to discover insights that could inform your investment decisions. Let's begin. SLB, previously known as Schlumberger, is a global leader in oilfield services, offering technologies for reservoir characterization, drilling, and production. Operating in over 120 countries, SLB leverages its scale and innovation. The company invests in low-carbon initiatives, positioning itself for energy transition opportunities. Examining SLB's balance sheet, we find cash and equivalents around $3 billion, while debt is near $13 billion, resulting in a net debt position of approximately $10 billion, where liabilities exceed liquid assets. The debt-to-equity ratio stands at about 0.6, indicating moderate financial leverage. A ratio below 1 means the company isn't heavily dependent on debt, which is positive. Retained earnings have been increasing steadily, reflecting consistent profitability. The presence of significant treasury stock suggests active share buybacks, signaling management's confidence in future prospects. However, it's crucial to monitor the debt levels to ensure that they remain manageable compared to earnings. The full balance sheet reveals that fixed assets have increased slightly, indicating ongoing investment in long-term resources. Current liabilities have decreased, enhancing short-term liquidity. These adjustments suggest a cautious yet stable strategy to balance growth with manageable risk. Reviewing SLB's income statement, we observe a steady improvement in the gross margin from 20% to 21%, indicating better efficiency in managing production costs relative to sales. The SG&A margin has decreased from 1.07% to 0.98%, showing enhanced control over administrative expenses. Net income margin remains strong at around 12%, reflecting consistent profitability. Notably, earnings per share have shifted from negative to positive, rising from a loss of 3 cents to gains of 3 cents and 6 cents. This positive EPS growth suggests value creation for shareholders. These trends indicate SLB is strengthening its operational performance, which is crucial for value investors seeking long-term opportunities. The complete income statement shows revenue growth in both services and product sales, suggesting robust demand. However, restructuring and merger costs are still a concern, indicating ongoing changes in business operations. Value investors should watch whether these expenses result in improved operational efficiency and competitiveness in the sector. SLB's revenue experienced a slight dip at the beginning of 2024, but rebounded in subsequent quarters, demonstrating operational resilience in the face of market fluctuations. Net income mirrored this trend, with profit margins consistently around 12%, indicating effective cost management relative to revenue. For value investors, consistent profitability is essential. Compared to competitors, SLB's swift recovery suggests a competitive edge. Determining whether these trends result from internal efficiencies or external market factors is vital to assess sustainability. It's also important to monitor industry developments that could affect future performance. SLB's free cash flow has been quite volatile, dropping to negative $101 million in the first quarter of 2024, before rebounding to $1.8 billion in the third quarter. Free cash flow, the cash generated after capital expenditures, is essential for dividends, debt repayment, or reinvestment. The free cash flow yield, comparing this cash flow to the company's market value, turned negative but recovered to 3.5%. Value investors prefer a steady positive free cash flow yield. The capex margin ranged between 40% and 56%, indicating fluctuating investment levels. Grasping these trends is crucial for evaluating SLB's financial health. The full cash flow statement shows that SLB's operating cash flow increased to $4.2 billion, highlighting solid efficiency in its core operations. However, net cash from investing activities stayed negative, indicating substantial capital expenditures. This could be a strategic growth move or a risk affecting liquidity. Comparing to industry benchmarks provides valuable context. Analysts predicted that SLB's revenues will grow at a moderate rate, underscoring the company's strong market position in the energy sector. Earnings per share are expected to increase, indicating effective cost management and potential margin expansion. Compared to peers, SLB's growth estimates are favorable, suggesting it may outperform industry averages. For value investors, these forecasts offer insight into the company's future performance and help assess whether the current stock price aligns with its intrinsic value, the true worth based on fundamentals rather than market price. From SLB's recent earnings call, management emphasized ongoing improvements in operational efficiency and a commitment to strategic investments. Leadership highlighted strong revenue growth and outlined plans to manage debt levels carefully. They also discussed initiatives in low-carbon technologies, positioning the company for future energy transitions. For investors, these insights reflect a proactive approach to market challenges and opportunities. Evaluating SLB's valuation metrics, its price-to-earnings ratio is 17.6 higher than competitors like NOV and HAL. A higher PE ratio can indicate market optimism about SLB's future earnings growth, but it might also suggest the stock is overvalued relative to its current earnings. The price-to-book ratio is 3.7, meaning the market values the company's assets at over 3 times their book value, higher than most peers, except WFRD. For value investors seeking potentially undervalued opportunities, lower PE and PB ratios, such as those of TS and NOV, might be more attractive. It's crucial to determine whether SLB's higher valuation is justified by its growth prospects and operational efficiencies. Now let's examine the discounted cash flow valuation of SLB. The DCF method estimates a company's intrinsic value by projecting future cash flows and discounting them to present value. SLB's strong cash flow generation and consistent revenue growth are positive indicators. However, we must consider risks like fluctuating oil prices that can impact future earnings. Compared to competitors, SLB's financial health is solid, but we need to assess if its free cash flow yield falls within an acceptable range. Analyzing these factors helps determine whether SLB's current market price reflects its true value, providing insights for value investors. Analysts expect steady growth for SLB, projecting increased earnings in the coming years. This optimism is based on the company's strong position in the oilfield services industry and its ability to benefit from rising energy demand. However, potential volatility in oil prices poses a risk that could affect future performance. Compared to its peers, SLB's forward price-to-earnings ratio seems reasonable, suggesting it's fairly valued in the market. Understanding these forecasts aids in assessing the potential risks and opportunities associated with investing in SLB. In summary, SLB's improving margins, evidenced by increased gross margins and positive EPS growth, reflect enhanced operational efficiency and profitability. The debt-to-equity ratio of 0.6 shows that although the company has significant debt, it maintains moderate financial leverage. Rising retained earnings and active share buybacks demonstrate management's confidence and commitment to shareholder value. However, fluctuations in free cash flow and substantial capital expenditures warrant cautious observation. For value investors, SLB's strong market position and financial improvements present a promising opportunity, but it's essential to balance these strengths against the potential risks linked to its debt levels. Be sure to watch another video from our Value Explorer series by clicking the playlist below.